Imagine putting your money somewhere it works for you while you sit on the couch, eating pizza, and pretending you understand property law. That's the promise of REITs, real estate investment trusts. A way to invest in real estate without unclogging tenants' toilets or negotiating with people who insist their cousin can do the plumbing cheaper. But are REITs really the safe haven they're marketed to be? Or are they just another shiny investment that looks sturdy until the economy sneezes? First, the basics. A REIT is a company that owns, operates, or finances income-producing real estate. Think shopping malls, apartment complexes, office towers, warehouses. By law, they have to pay out at least 90% of their taxable income as dividends to shareholders. Translation: you invest, they collect rent, they send you checks. Sounds safe, right? That's the marketing pitch. Steady income, low hassle. But steady doesn't mean bulletproof. Here's the upside. REITs can be a great source of passive income. Historically, they've offered dividend yields higher than most stocks, sometimes 4 to 6% or more. And because they trade like regular stocks, you can buy or sell them without hiring a real estate lawyer who bills in 6-minute increments. They also diversify your portfolio. When your tech stocks are doing the financial equivalent of bungee jumping without a cord, REITs often move differently because they're tied to property markets, not just market hype. But let's talk about the cracks in the safe haven myth. First, REITs are still stocks. They live and die in the same market as everything else. In a recession, property values drop, tenants default, and rental income falls. Your safe REIT can sink just as fast as your favorite growth stock. Except now, you're losing money and watching the commercial real estate headlines implode. Then there's interest rates. REITs love low rates because borrowing is cheaper, property values climb, and yields look attractive compared to bonds. But when rates spike, suddenly that 5% dividend doesn't look so special when you can get similar returns from a risk-free treasury bond. Investors pull out, share prices drop, and your haven starts looking like a sandcastle at high tide. And here's the sneaky part: sector risk. Not all REITs are created equal. A warehouse REIT supplying Amazon? Different beast entirely from a REIT owning suburban malls where the biggest tenant is a discount shoe store. Some REITs are thriving: data centers, logistics hubs, cell towers. Others are in slow-motion collapse. Traditional office REITs, especially in cities where half the workforce discovered they can do their jobs from a couch in sweatpants. If you buy without knowing the sector, you're not investing. You're gambling on real estate roulette. The tax side isn't all champagne either. REIT dividends don't get the lower qualified dividend tax rate. They're taxed as ordinary income, which means Uncle Sam might take a bigger bite than you expect. If you're in a high tax bracket, that steady yield can lose its shine pretty quickly. So why do some people still swear by them? Because when chosen carefully, REITs can be a consistent income engine. During certain periods, they've outperformed the S&P 500 even after taxes. And in inflationary times, well-managed REITs can raise rents, protecting your purchasing power better than some fixed income investments. But you have to pick your players. A self-storage REIT with strong occupancy and low overhead is not the same as an office REIT praying someone rents their half-empty skyscraper. Here's the mindset shift. Don't think of REITs as a magical safe harbor. Think of them as ships in a fleet. Some are sturdy, built to weather storms. Others are leaky yachts, owned by captains who overspent in boom times and now can't afford repairs. The safe haven myth works only if you're willing to inspect the ship before you climb aboard. So how do you do that? Start with the basics. Check the dividend payout ratio. If a REIT is paying more than it earns, it's burning the furniture to keep the lights on. Look at debt levels. High leverage means higher risk, when interest rates rise. Examine the tenant base. Are they financially healthy? Are leases long-term or about to expire? And for the love of diversification, don't put all your REIT money into one sector. If retail real estate tanks, you don't want your entire portfolio riding that wave down. The truth is, REITs can be both safe and risky, depending on how you use them. They're not a get-rich-quick scheme, but they're not a guaranteed fortress either. They're tools. In the right hands, they generate steady income, hedge against inflation, and diversify your holdings. In the wrong hands, they're a slow leak that drains your portfolio over years. So, are REITs really a safe haven? Only if you treat them like any other investment. Do the research, understand the risks, and resist the temptation to believe the sales pitch that they're immune to market chaos. Because in the end, no investment is truly unsinkable. Not even one that sends you a nice dividend check every quarter while you're eating pizza.